Okay, where do we go from here? So a couple chapters ago we learned to account for the sale of merchandise using a perpetual inventory system. So when we did that, we accounted for the sale by debiting accounts receivable and crediting sales for the sales price, and then we accounted for the movement of inventory because we use perpetual inventory by debiting cost of merchandise sold and crediting merchandise inventory. Then in the next chapter we focused solely on the second portion where we learned how to account for our inventory. We either did LIFO, FIFO, or average cost, and that told us what amount to use for our inventory. So in this chapter we're going to be focusing on this top portion, how to account for accounts receivable. If we sell on credit, that is, we don't require payment up front, we will inevitably have some bad debt expense. So we're going to learn how to account for that. This video is going to give you an overview so that you know what to expect when you read your chapter and you look at your PowerPoint. So here's the overview. It's just something to keep in mind about where we're going with all of this. So there's going to be two methods to account for these bad debts, that is, people that aren't going to pay us our money. The first method is going to be the direct write-off method, and the second method is going to be the allowance method. The direct write-off method is used by smaller companies. It's not in compliance with GAAP, but that's okay because non-publicly traded companies don't have to be in compliance with GAAP, so they can use the direct write-off method. The second method, which is in compliance with GAAP and it does follow the matching principle, is called the allowance method. Under the allowance method, we're going to be estimating our bad debts, and we'll have two options to estimate them with. And the two options that we may estimate our bad debts are going to be the percent of sales method and then the aging of accounts receivable method. And whichever method we're asked to do changes how we do it just a little bit. So you have to know which method you're going to be using, and we're going to use both in this chapter. Alright, so some of the important accounts that we're going to use in this chapter are receivables. Any type of receivable. Could be accounts receivable, notes receivable, interest receivable. All of these are assets because it's our right to receive that value, usually cash. Normal balance of any asset, of course, is a debit, and assets are found on our balance sheet. The other account that's going to be important is our bad debt expense. This is an expense, and expenses, of course, have a debit balance. And the financial statement that report expenses is the income statement. And then a brand new account called the Allowance for Doubtful Accounts is going to be a contra asset because it is contra to accounts receivable. Since an asset has a debit balance, and this is contra to that, it has a normal credit balance, and it is found on the balance sheet right underneath accounts receivable. So here's how it would work. If somebody owes $500,000 and we set up an allowance, which you'll learn how to do, of $30,000, we would look at the receivable netted with its allowance account of $30,000, and we would find out that the net realizable value, the amount that we expect to get from our receivables, would be the net amount. A debit with a credit, you subtract, so that would be our net realizable value. And again, that is because a receivable next to its contra account gets you to the net realizable value. So you'll want to read your chapter, look at your PowerPoint, watch my other video that explains all of this in detail, and then work through your problems and let me know if you have any questions.